In the last two videos, we talked about how the tax code rewards ownership and why labor is taxed first while capital is taxed last. This video connects those ideas to something people experience very directly. Why business owners and investors seem to be playing a completely different game. Not a better game, not a fairer game, a different one. Once you understand why that difference exists, a lot of frustration turns into clarity. The biggest misconception people have about the economy is that everyone is operating inside the same system at different income levels. It isn't true. There are two fundamentally different roles in the tax system: labor and ownership. Labor supplies effort. Ownership supplies capital and risk. The tax code treats those roles differently because they serve different functions. Labor is immediate and certain. Ownership is deferred and uncertain, and the system builds incentives around that distinction. When a business owner or investor pays less tax at the same income level as a high earner, it isn't because they're gaming the system. It's because they're operating inside a different incentive structure. Business owners don't just earn income. They decide how income is created, timed, reinvested, and distributed. They can choose whether profit stays inside a business or is distributed later. They can decide when income becomes personal. They can influence whether returns show up as wages, profits, or long-term gains. That flexibility isn't accidental. The system is designed to encourage people to build productive enterprises, even if those enterprises fail. From a policy perspective, risk-bearing behavior matters more than guaranteed outcomes. That's why business owners are given optionality, not because they're special, but because the system wants more of what they're doing. Investors operate under the same logic. When you invest capital, you commit resources without knowing the outcome. You might lose money, you might tie it up for years, you might never see a return, so the tax system waits. It allows deferral, basis recovery, and often preferential treatment when gains are realized. Again, this isn't a reward for wealth, it's an incentive for participation. Capital that never gets deployed doesn't build anything, so the system makes patience and risk more tolerable. The gap between labor and ownership hasn't widened because the tax code changed. It widened because access and education changed. Fewer people are taught how businesses actually work. Fewer people are shown how capital compounds. Fewer people are positioned to move beyond labor alone. So you end up with two groups living under the same tax code but experiencing it very differently. One feels overtaxed and stuck. The other feels flexible and strategic. That difference breeds resentment, not because one group is immoral, but because the system is opaque. This isn't about rich versus poor. It isn't about capitalism versus socialism. It's about roles. The tax code doesn't ask how much money you have. It asks how you participate. Do you supply labor or do you deploy capital? Do you take guaranteed income or uncertain returns? Do you need immediacy or can you wait? Those choices determine how the system treats you. Until people understand that, the conversation stays emotional instead of productive. Once you see this clearly, the real question isn't whether business owners and investors play a different game. They do. The real question is whether you understand the rules of that game well enough to participate intelligently. Because ownership without understanding doesn't create freedom, it creates risk. And that's where due diligence becomes essential, not to discourage ownership, but to make sure participation doesn't turn into an expensive lesson.